Hey guys, welcome back to the show. I'm Dr. Johnny Walker, and this is the Walk of Wealth. Today, we have a very exciting topic, and we're going to be talking about 1031 exchanges for syndicated investments or passive investments. And in this channel, if you know, we focus on building financial freedom through passive investments in real estate and other alternative assets. One of the most common ways to invest passively in real estate as an LP through a syndicated structure. So, of course, if you follow this channel long enough, you know that there are all the benefits of investing passively. But then we kind of overlook at the end of the deal that we have to pay taxes. Or is that true? And that's what we're going to kind of get into today, real estate for syndicated investments, very specifically. And I'm joined by Dasha Beardsley, who is the author of this book, which is Maximizing Wealth Through Syndicated 1031 Exchanges. Very powerful strategy and something that we all should really understand if we want to maximize our wealth. So Dasha, I want to welcome you to the channel. I think this might be the second time you've been here, but thanks you for being here.
Yeah, thank you so much for having me on again.
So Dasha, let's jump right in. Now, for those of us that's not, familiar with it, what exactly is a 1031 exchange, right? And why is it so powerful in real estate?
1031 exchanges refers to Section 1031 of the tax code, which basically allows investors, real estate investors or real property investors to defer all capital gains tax when they sell a property if they exchange into another piece of real property that is both equal in value or greater than and has to cover at least the equity portion. So you can, of course, flex up or purchase a property for the exact same price. And of course, you have to match your equity from your previous sale. But basically, it's a very powerful tool where you can indefinitely defer your capital gains tax. And if you keep 1031 exchanging until you pass, your heirs get your stepped up basis. So it kind of intersects with estate planning as well.
Very cool. You said a lot there. So now 1031 exchange, like to really break at a very simple level. Now, say I've invested, well, no, let's not get into a specific example right now, but basically you're saying when you sell real estate, right? Say you buy real estate for $1 million and it's worth $2 million in 5 years, then there's $1 million gain. Now, if you sell that for $2 million, then you would be on that $1 million gain, you would be subject to capital gains taxes, right? So somewhere between, let's say 22 to 25%, depending on what state you live in. So you're really looking at, on a $100,000 profit, you're looking at paying the IRS between $22,000 and $25,000 in capital gains taxes. But you're saying that, hey, by reinvesting these proceeds into another deal that has more debt and at least the same amount of equity, I believe you said?
It's basically either the same amount of equity and total purchase price. So you can take on more debt if you'd like, but you have to match your debt as well and equity as a minimum if you want to defer all the taxes. That's also something that I wanted to talk about, just a little side note, is that because of that rule with 1031 exchanges, it's thought of as being more rigid than it really is. So people think, I have to at least get the same amount. You do if you want to defer all of your capital gains tax, but it's still worth it if you have a property that's 90% of the value of your previous property, and you just don't defer all of your taxes. So I think that that's something that is lost a little bit, perhaps in translation, but I think it's really important to know because it's better to make the better investment choice rather than to defer all of the capital gains tax.
Very interesting point. So you're saying that you don't have to roll over all of it. You can do partial capital gain. You can take partial profit, physical receipt, pay capital gains, and part of it you can defer?
Exactly.
Wow.
You just wouldn't be deferring all of your taxes, but that's fine. As long as you get most of it or, a meaningful portion, it's still worth it.
Wow. Okay. That's amazing. All right. I learned that for myself today. So yeah. So now you can see that if you employ this 1031 exchange strategy, then instead of on that $1 million gain, instead of paying or $250,000 in taxes, if you roll into another deal or real estate deal, you can defer paying those taxes and invest all of that capital potentially, or partial, as we spoke about. Now, this 1031 exchange, I've heard about this obviously and I think this is probably one of the most powerful tools in real estate, period, in terms of tax strategies. Now, can we break it down a little bit into, like, why is it that we haven't heard about this for syndications, right? So on this channel, we're passive investors, LP investors potentially, or majority of the time as LPs. Now, why is it that we haven't heard of 1031 exchanges as a passive investor? At least not before I've read this incredible book.
So with typical syndications, when an investor is investing passively, or as an LP, they are not typically investing into real property. They are investing into a partnership and are purchasing securities. So that does not qualify for 1031 exchanges, which is why it requires slightly more complicated structuring in order to get a 1031 exchange into a syndication. Of course, there's two main ways that you can do this, which is with a DST structure, which stands for Delaware Statutory Trust. We do not do those at LSCRE. We do TIC structures, which stands for tenant in common. So when we have an investor that is looking to bring in a 1031 exchange into one of our syndicated offerings, they come in as a tenant in common with us. So they are actually purchasing real property and are shoulder to shoulder in their ownership. They just own a proportional amount of the property based on their equity amount out of the total equity amount for the deal.
Got it. So how does it work, right? Like how do we take advantage of this as a limited partner? Like, do we have an option, or can any deal that we get into, can you do this, like, or does it have to be set up in a certain way? I haven't ever heard of other sponsors even tell me, hey, we have an option for 1031 exchange.
Mm-hmm. Well, due to the more complex nature of doing 1031 exchanges in general and for syndications, a lot of sponsors are kind of more hesitant. It's more kind of legal complexities that they're not looking to get into. So even if they do offer it, typically it's for a very high minimum. That being said, for our TIC 1031 exchanges, so that would be, for example, an investor owns their own condo building and they're selling it, they're looking to passively invest and no longer be an active owner. That was what we would call like a TIC 1031, and the way that we would structure that, our minimum is $1 million, which is a lot higher than our typical $50,000 minimum investment as an LP investor. But still, on relatively speaking, that's a pretty low 1031 exchange minimum. So we are very 1031 friendly, I would say, as a firm. That being said, there's two main ways to take advantage of this as a limited partner investor or just as a syndication investor. So one is the way that I just described. You're an active owner of real estate and you're looking to then passively invest into one of our syndicated 1031 offerings. So that would be the TIC structure. Second, and this is of course all up to the sponsor to facilitate this 1031 exchange, but if you are invested as a LP, as I mentioned earlier, you're investing into a partnership with all of the other investors, and you're purchasing securities most likely. So that is not real property, but there's still the opportunity to 1031 exchange if the sponsor then facilitates a rollover or a 1031 exchange into their next offering. So the way that that's done is that partnership that investors are investing into as a limited partner, that entity is being used to purchase the next property. So that entity would be a TIC or a tenant in common in the next property that you're purchasing. So that's the way that that is handled. In those situations, we call that a syndication to syndication exchange. And that is, if offered to investors, there's the option to roll in or out of the exchange, cash out and not go on to the next property, or defer your taxes and go to, the next property. What's really nice about that structure is that technically, from a legal perspective, there isn't a minimum amount of investors that need to roll over into the next property in order for the exchange to be valid. So, you'd think maybe there's like a 50% threshold. There isn't anything like that. It would just, from a sponsor's perspective, there would probably be a minimum amount of equity that would need to roll over in order to make sense, to make the exchange make sense, but there is no minimum. And the times that we've offered this to our investors, it's been very well received.
Yeah. So now it seems like there's two things you talked about, right? Like, so getting in the first place, you say, for example, you own some real estate, maybe you even own your dental building, right? So you're a doctor or a dentist, and you own the facility, the building that you live in, that you work out of, sorry. Now, we've had situations, we did a deal earlier this year, we did a triple net dental real estate deal, where maybe the dentist is not interested in being a landlord anymore. Maybe, they've been holding the property, they don't have any loans, and they're looking to offload and sell the property, right? So if you are looking to sell the property, we are buying. So definitely DM me if you're a dentist looking to sell your property. We are buying, and then triple net leasing it back. Obviously, in leasing it back, we need to be a strong operator. But now in this scenario, Dasha, say they go and sell their building. And they're a successful doctor. They have, maybe 3 locations, right? So within a strip mall, they have their dental office, maybe a pharmacy, and then maybe a convenience store or whatever. Now they go and say, hey, look, I'm not interested in being landlord anymore. I've paid off my property. I have somebody come in. Dr. Johnny's group wants to come and buy the building from me. I'm only interested in doing dentistry and running my business. I'm going to sell this building for $2 million. I bought it for $1 million, $800,000 15 years ago, or I bought it for $500,000 15 years ago. I got $1.5 million of profit, and I can realize it cash out. So I'm going to do it. Now they cash out. They sell this building for $2 million. They made $1.5 million on it. But now they're going to have to pay massive taxes on that, right? So let's say 25% taxes. They're going to have to pay $375,000 in taxes. Huge tax bill. Now, Dasha, you're saying like, hey, look, instead of paying these capital gains, you could be like, hey, look, I'm not interested in being a landlord, but I'm also not interested in this huge tax bill, but I am interested in passively investing in real estate where I don't have to deal with tenants. I don't have to deal with termites. I don't have to spend my time, right? Now you're saying that you can roll, instead of paying that $330,000 in taxes and taking $1.2 million of cash profit, you're saying you could roll that entire amount into a passive investment through a TIC structure and defer paying all those capital gains taxes, right? So instead of paying $330,000, you're not paying any taxes and you're rolling all of the proceeds into a passive investment. Would you say that's correct?
That's correct.
That's huge right there, guys, right? Just that one little piece of knowledge saves you $330,000. That's a $330,000 gain. All right, you're welcome, guys. This video's over now. You got your value. No, I'm just kidding. But look, so you can already see the power of that. Now that's getting in. Now you're invested into this real estate deal. Now, Dasha, say now they invest into this doctor. They've sold their building. They haven't paid taxes. They've rolled it through a TIC structure into a syndicated investment. Now, let's say if it fast forward 5 years, that investment does very well, and this doctor now doubles their money, right? So now they have $2 million, and now they've invested it into this deal, and now the deal is worth $4 million. Now, don't they have now you're saying that if they were to sell and they were to take receipt of that $4 million, they're still at a $500,000 basis going in, right? So they still would have to pay taxes on that entire gain.
Yep.
$3.5 million of taxes, right? But, and this is the beautiful, powerful thing about this 1031 exchange that we're talking about here, is if the sponsor is set up in the correct way, and the sponsor is entertaining, hey, we're going to roll the profits. If there's enough interest, we're going to roll the profits into our next deal, then you can defer those taxes again. Is that right, Dasha? Like, hey, look, you can take that full $4 million and not pay capital gains on $3.5 million and roll it into yet another property. Kicking the can down the road, not paying taxes, compounding the growth. Is this accurate? Is this accurate so far? Have I got a general gist of what you're saying?
So the deferral is correct. You can continue to defer. What I will say is that if you're coming into the deal as a tenant in common, as a TIC, you can exchange out of the investment as well. So if you, let's just say, invested into the syndication as a TIC, 1031 exchange, and then you sell and you want to actually buy another dental building and do that yourself and be, an active owner again, you have the flexibility to do so. You could also take that TIC and go invest into, with another sponsor that's accepting TIC 1031 exchanges. So the only time where you are, I guess, restricted to that sponsor to do the 1031 exchange is when you are a limited partner 1031 exchange. That's the only time. If that TIC structure provides the most flexibility. So of course you can exchange into the next deal if the sponsor is offering that opportunity, but you can also have the flexibility. You're not relying on the sponsor for your next 1031.
And that's only if you're going into the deal from a TIC structure, like maybe selling real estate or something like real estate, active real estate, and moving in. Whereas if you had invested as an LP from the onset, that option wouldn't be there.
Right. The option to 1031 exchange would only
into an active property.
Right. You're not able to do that.
Got it.
Because it needs to be within that investor entity that the sponsor manages. That entity would need to be the one actually doing the 1031 exchange. So as a limited partner, you don't have the capability to do that.
Got it. Because from the onset, it's the GP that is basically running that TIC structure, right? So they are the ones that can execute or not, right? Is that right? Whereas, so when you're an LP, you don't have that optionality. But if you enter in the beginning as a TIC structure, then you have a little bit more flexibility on the exit.
Right.
Is that correct?
Yep.
Okay,
Which
cool.
is also, that's not why, but with a TIC structure, there's the higher minimum.
Higher minimum. Got it. So now, can you tell me, I know you had a beautiful graph about this before. Now, let's just look at this conceptually from 10,000 feet. If you were to invest in a deal, and then after 5 years, the deal does well, and then you pay capital gains taxes on it, then reinvest the profits into another deal, and say the deal does well, you make money, you pay taxes on it, keep the gains, reinvest it, and do that for 20 years, or you do what we're talking about here, and you don't pay taxes between each investment. You invest, and 5 years later, you don't pay any capital gains tax and roll the entire amount into a next deal. And then presumably that deal, working assumption, that deal also does well. You make money. You don't pay tax. You make money on that deal. You don't pay taxes again. You 1031 exchange and roll it into another deal. I think after 20 years, you said you invest 100 grand.
It's 30
After
years.
20 years, the difference starts to get very, very, very stark.
Yes. So
Right?
we modeled out the difference between, like you were talking about, paying taxes after each sale and reinvestment or using 1031 exchanges. So from both an initial investment of 100,000. If you do pay taxes throughout 30 years of reinvesting with an average hold period of 5 years, your investment would turn into 1.1 million, which is fantastic. That same investment, average hold of 5 years, 100,000 initial investment over 30 years, but using 1031 exchanges, it would grow to $2.9 million instead. So it's over double.
You see that? That is the power of compounding, right? So the biggest crusher of building wealth for anyone is taxes. So if you can find a way to mitigate taxes, the stark difference. So restate what Dasha said. You invest 100 grand and say every 5 years you're doubling your money. We're going to work with that assumption, and you're paying taxes the entire time. Each time you use a sale, 100 grand would turn to 1.1 million over 30 years. Still sounds very good. It's over 10 times your money. But if you don't pay the taxes and you keep taxed and the same 100 grand, 30 years later, the difference, it becomes 2.8 million. Almost triple. You almost make triple the amount of money that you would just by paying less taxes. It's about investing smarter. It's not about, hey, I have to make 20% or 30% on each investment. No, it's, hey, are there ways that I can defer taxes? Because guess what? The overall net return gets a lot bigger if just by learning to mitigate taxes. So that's why this strategy is so powerful. Now, can you break down, and you mentioned DST, a Delaware Statutory Trust, and TIC structure, which is tenancy in common. Can you break it down a little bit more how they work in syndicated deals, especially the TIC, because this is what you employ. What exactly does that mean, and what is a TIC?
So a TIC, as we discussed, was a tenant in common. So it's basically an ownership structure where there are multiple owners that have their own separate ownership structures into a deal. So basically that is what allows an investor to come in and actually own direct title to the property. So the tenant in common refers to purchasing real property. So you wouldn't be, that structure wouldn't apply to, the investors, limited partner investors investing into an investor entity. So that's how that works with the Delaware Statutory Trust, or a DST. Those are probably one of the most common ways to invest into a syndication. Typically the minimums are a lot lower, and I guess let me back up. With a tenant in common, you're legally allowed to have up to 35 in one offering. That being said, I don't think your lender would be very happy about that. Getting up to 5 ticks in one deal is, kind of pushing it a little. It's definitely doable. We've done that before. But the lender, since the TIC investor is purchasing, the real property, the lender views the investor as a borrower. So they need to do some due diligence on the 1031 exchange investor. So that being said, it's not very plausible to have, a bunch of them, even, up to 35.
Does that increase your liability as well? Does that, as if you're coming in as a TIC structure, since you're directly owning the real estate?
So we normally are able to structure it where our 1031 exchange investors do not have to sign on the loan. Our loans are non-recourse, so I wouldn't say that it's significantly more liability as a 1031 exchange investor. So that's a great question. But regardless of that, the lender still wants to understand who this investor is and do some due diligence, such as understanding what types of real estate that they own, what their experience is, and things like that. So the IRS has a limit for 35 ticks into one deal. For DSTs, you're able to have up to 499 DSTs in one deal. So that would make sense why the minimums are usually significantly lower. DSTs, although they provide more flexibility with the number of DSTs in one deal, they're a bit more rigid in their requirements than a TIC structure. For example, with DST, the capital calls are not allowed. So the sponsor who is conducting or offering the DST investments, they're not able to have a capital call at any point in the investment. So that causes the structure to, which let me preface, most of us in this industry do not want to avoid a capital call at all costs. And, we don't plan on them, but our ability to do them if needed allows us to structure our deals more efficiently. So if you're not able to do a capital call at all, that causes the DST investments to take on significantly more reserves, really very, very low leverage. So, it's a more conservative business plan, but it's just not quite the most efficient for your equity. That being said, I think it can be a great option. It's just something that I want to caveat. There also isn't flexibility with the exit date. So when a DST sponsor is, setting out to have their offering, they have to decide when they're going to exit the investment, and there isn't really much flexibility outside of that. So, with our TIC structures, we're able to exit whenever, is best for us and our investors. So I think that added flexibility is very important, as we're kind of going through different market cycles.
All right, look, see, I'm already sold on passive investing. Obviously, that's why I have this platform. That's why I'm here teaching people how to do it. And now there's, it's also not just learning about how to become a great investor and get great returns. It's like we've been talking about, it's, hey, how do we reduce taxes and increase compounding? Now, this is already phenomenal news, like especially as an LP investor. Hey, there's ways that we can even reduce capital gains taxes through these 1031 exchanges. Now, why can't I go and do this with any deal, that any syndicated investment that, and like, for example, we invested in a self-storage deal, right? And we invested in mobile home parks. This has never been offered to us. Hey, look, you'll be able to 1031 exchange. Why can't we do this in any syndication?
If it's real property, like real estate, so, mobile home parks would work, self-storage would work, you technically can.
You can.
You can.
So if the sponsor, it doesn't matter how, doesn't the sponsor have to have the deal set up in a certain way?
Well, yes, they have to accept 1031 exchanges, and then for LPs, if they want to do a syndication to syndication exchange, they would have to be the ones to facilitate it. And then they would also have to be the ones to, accept 1031 exchanges into their offering on the front end.
And you're saying that because of the complexity and maybe the lack of understanding that's out there, a lot of sponsors don't do this or accept 10. Would that be an accurate statement?
Yeah, I would say it's more just the added headache. I've talked to some sponsors that are like, yeah, we've done it before, and our minimum is 3 million if we are going to do it.
Wow.
Just because it is definitely more work with coordinating with the lender and things like that. That being said, it's not that much additional work, in my opinion, for the investor. I think it's well worth it. But yeah, we've done, as a firm, we've done over $60 million worth of 1031 exchanges into our offering. So we're definitely very well versed in it, and we don't shy away from the added complexity.
Yeah, I know you guys get some really, really complex things done that a lot of sponsors don't. I remember you guys just recently did a REIT conversion, which was another property that was overlooked by many due to the complexity of it. And Lone Star doesn't seem to shy away from that complexity, and that obviously uncovers a lot of opportunities. So, kudos to you guys about that. And then, kind of landing the plane, you've kind of answered this question a little bit, but, one of the more advanced strategies in your book is the syndication to syndication exchange, right? Can you go in a little bit more detail? How does it work, and what are the advantages for us as LPs?
So the syndication to syndication exchange is what we were talking about with a limited partner, LP
Mhm.
investor investing passively, and
Mhm.
offering the capability to 1031 exchange into the next offering that is done by the sponsor. So there is it is more rigid in the way that you, as an LP investor, would need to be rolling over into the offering that the sponsor is offering versus TIC. You can go and do whatever you'd like with that investment after the sale. So the way that that works is basically the sponsor would be acquiring a new property and facilitating the exchange. Investors would be given the opportunity to cash out, just upon exit, take their money and be happy with it, or they can do a 1031 exchange with the sponsor and they would be able to defer all capital gains tax. And also something we haven't talked about yet is deferred depreciation recapture as well. So that is a very compelling strategy, especially right now, when 100% bonus depreciation is back. And of course, that depreciation recapture will be, effective upon sale. But if you 1031 exchange, that is also deferred.
Right. Exactly. Now, the bonus depreciation can obviously help to offset some of those capital gains, right? If you don't have the ability to 1031 exchange, but you have enough passive losses, that can kind of help to
Right.
mitigate that tax and that a little bit as well, right? So, taking advantage of bonus depreciation is also, I think that's paramount as well. Is there anything else that you want to add, Dasha? I mean, this has been a very, very helpful interview, so I thank you very much for coming and spreading your information and knowledge about this. Is there anything else that you want to add about this topic?
Yeah, I would say that if you're an active landlord or property owner and you're interested in doing a 1031 exchange, I'd say learning about it as early as possible is definitely the good thing to do. And also finding a good qualified intermediary early on in the process will just make things a lot smoother. I have a lot of investors that come up to me saying they're planning on doing a 1031 exchange for their upcoming sale, but they don't have a qualified intermediary or don't even know what that is. And that is extremely important that you have one set up prior to the sale of your property. Otherwise, your exchange will no longer be eligible. So you are not, for a 1031 exchange, you are not able to receive your funds from your sale. It has to go to a qualified intermediary. So this is just a disclaimer that you definitely want to set that up well in advance of your sale.
Yeah, because once you've taken physical receipt of the money, all bets are off, right? Like you cannot take the money from the proceeds of the sale ever. Otherwise, you're null and void for 1031 exchange. You guys, so this book, what you're talking about, everything we talked about right here, this is the book. This is the only book in the market talking about this stuff, right? So it's a very unique book. It's very well positioned. It's very much pertinent to everything that we do on this channel. So definitely go pick up this book. Dasha, where's the best place to pick up this book? I think is it available on Amazon?
Yeah,
This is
it's
Dasha
available on
Beardsley.
Amazon. We
Yeah.
also have the URL maximizing1031.com. So that works out.
What is it? 1031maximizing.com?
Maximizing1031.com.
Maximizing1031.com, you guys. So you can check out this book on Amazon, or it's only like, what is it, like $8-10 worth every penny. It might make the difference of hundreds of thousands of millions of dollars in your career, and that's facts. So Dasha, again, thank you for being here. Now, if anybody wants to learn more about you or get in touch with you, what's the best way to do that?
You can email me at Dasha, DASHA, at lscre.com.
Awesome. And Dasha, once again, thank you very much for being here. You're an awesome guest. You spread great information that's I know will be well received with our community. And all right, guys. So with that, I will see you next time, and we'll see you on the next video next week. Take care, guys.